As of today, July 30th, 2026, market activity is currently in its pre-market session, with NVIDIA stock trading at approximately $194.74, reflecting a slight dip of 1.15% from its previous official session close of $190.01, where it dropped 3.55%. Wall Street has built a comfortable narrative around this business, that it is an unstoppable computing giant destined to absorb every available capital expenditure budget across the technology landscape. However, the true reality playing out underneath the hood is far more complex than simple retail optimism suggests. While casual observers look at headline valuation figures and assume the growth story remains linear, big institutional desks are quietly rebalancing their positions, bracing for a structural transition in how enterprise capital gets allocated toward hardware. Every mainstream commentator will tell you that holding NVIDIA stock is an absolute necessity if you want exposure to modern computing infrastructure. The consensus expectation suggests that as long as tech giants continue expanding their data center budgets, hardware vendors will enjoy unlimited pricing power and endless backorders. But if you take a closer look at the actual mechanics of current corporate spending, a counterintuitive reality emerges. Cloud service providers are actively accelerating their internal custom silicon projects, moving away from total reliance on third-party graphics processing units to protect their own operating margins. What looks like an eternal monopoly from the outside is actually the beginning of a fierce efficiency cycle where customers are trying to lower their cost per unit of compute. When you look at options flow and daily trading volume across platforms like Interactive Brokers and Robinhood, it becomes obvious that short-term volatility is being driven by institutional profit-taking rather than fundamental weakness. Over the last few sessions, volume spikes have aligned with broader semiconductor sector pullbacks as hedge funds shift capital into defensive income plays while waiting for the next catalysts. Retail traders using the Robinhood app or active accounts on SoFi Invest often see these red trading days and panic, assuming the bull case has fractured. In truth, institutional money managers using Fidelity Wealth Management Services or Schwab Intelligent Portfolios view these pullbacks as routine portfolio rebalancing within a higher interest rate environment where multi-trillion-dollar market caps face natural valuation resistance. To understand why the price action is behaving this way, you have to dissect how modern portfolios are built. Investors utilizing automated allocation tools like a SoFi Robo-Advisor or Schwab Intelligent Portfolios automatically rebalance away from concentrated tech holdings when individual equities outgrow their risk parameters. If an asset like NVIDIA stock grows to represent an oversized percentage of a fund, risk models force managers to sell off slices of their position, regardless of how strong the company's fundamentals might be. This mechanical selling creates temporary downward pressure, confusing individual traders who expect stock prices to strictly mirror earnings performance. Take a moment right now and drop a comment below telling us how many shares of NVIDIA stock you are currently holding in your portfolio and what your average cost basis looks like. Beyond structural fund rebalancing, the broader semiconductor space is grappling with macroeconomic headwinds that affect everything from broad index ETFs to individual brokerage accounts. Whether you trade through Fidelity Brokerage, manage an Interactive Brokers account, or utilize self-investing features on major investing sites, the overarching market sentiment has shifted from uncritical excitement to severe balance sheet scrutiny. Investors want to see clear return on investment metrics from the mega-cap tech customers who buy these massive server clusters. When end users question whether their software features justify billions in hardware expenditure, the hardware suppliers naturally feel the ripple effects in their stock valuations. Despite these short-term market fluctuations, the underlying business mechanics remain extraordinarily robust. At its core, the company designs high-performance graphics processing units, accelerated computing architectures, and deeply integrated software stacks that form the backbone of modern data centers, autonomous vehicles, and complex simulation platforms. Their primary business model relies on selling hardware nodes alongside proprietary software stacks that lock customers into their proprietary computing ecosystem. Historical financial reports demonstrate an enterprise capable of achieving gross margins well above 70%, a figure almost unheard of in hardware manufacturing. Previous quarterly results showed revenue scaling at breathtaking speeds, proving that when infrastructure build-outs are in full swing, their hardware remains the premier choice for heavy parallel processing loads. Looking toward the future, the dynamic between market expectations and operational reality will dictate where the share price goes next. The optimistic scenario hinges on next-generation architecture rollouts and expanding software licensing revenue, which could push overall market capitalization back toward record highs. Potential catalysts include expanding enterprise adoption beyond hyperscale cloud providers into corporate IT departments, healthcare diagnostics, and industrial robotics. Conversely, the downside risks cannot be ignored. Increasing trade restrictions, supply chain bottlenecks at third-party foundries, and aggressive custom chip developments from major customers represent real threats to long-term market share. If custom silicon proves cost-effective for everyday workloads, the high pricing power that built current margin profiles could face steady compression. Navigating this environment requires looking past daily headlines and understanding how capital flows through modern trading platforms. Whether you prefer online investing through SoFi Active Investing, building a long-term position via Fidelity mutual funds and Fidelity ETFs, or trading intraday swings on the Robinhood stock trading platform, success comes down to separating noise from structural shifts. The expectation was that hardware dominance would remain unchallenged and frictionless forever. The reality is that the market is entering a mature phase where efficiency, customer self-reliance, and valuation discipline will determine the true winners. Wall Street may react to every minor price swing with dramatized anxiety, but disciplined investors who analyze raw data, enterprise capital expenditure plans, and institutional order flow will recognize that volatility is simply the price of admission for high-growth sector leaders.